almost always when you have a momentum breakout, the spread will follow. Or if this were momentum of price, then price would follow. So we're focused also on the momentum of the spread, because when it breaks out, that gives us a heads up. Expect the spread chart itself. Now, what does this mean? It means as gold enters a massive asset shift favoring itself versus stock market, within the monetary metals, silver's about to shift into a leadership position. So yeah, gold thumbs up, but silver 2 thumbs up, because it's going to beat gold. So if you're focused on monetary metals or miners, my personal emphasis is on silver and silver related, as opposed to gold and gold related.
The relationship between gold and the S&P 500 is entering a phase that very few analysts are prepared for. Michael Oliver's work shows that gold's performance relative to the S&P is pressing against a decade-long resistance line, a line that has defined the balance between monetary metals and U.S. equities since 2015. Every prior touch of this line coincided with major external shocks: the 2015 market tremor, the COVID crisis in 2020, and the violent equities sell-off in early 2023. Yet today, the spread is pushing back into breakout territory without any obvious exogenous driver. That, in Oliver's view, is the clearest signal that an internal revaluation is unfolding inside the market itself. The S&P is no longer dictating the direction. Rather, gold is asserting dominance even as equities remain historically elevated. When a spread breaks out under these conditions, the shift usually lasts for years. From here, Oliver shifts to an even more compelling development: the behavior of spreads inside the monetary metals themselves. When gold strengthens relative to the S&P, silver often responds with amplified volatility, and historically, it tends to outperform gold during major transitions in monetary demand. Oliver argues that silver is again approaching one of those inflection points. The silver versus gold spread has spent years grinding down to levels that he describes as next to free, a condition that rarely persists for long. Now, both the price spread and the momentum spread have returned to key structural ceilings. Momentum is pressing against the breakout level, and Oliver emphasizes that momentum almost always leads price. That, in his view, is the market's quiet confirmation that silver is preparing to take leadership. This is why Oliver places heavier emphasis on silver and silver-related equities than on gold and gold miners. While gold has already broken to new highs and gold miners have exceeded their 2011 levels, silver miners remain deeply undervalued relative to their historical peaks. That lag is not a sign of weakness. It is the kind of structural compression that precedes accelerated catch-up phases. Oliver sees the current spreads, silver versus gold, SIL versus GDX, and silver versus the broader metals complex, all converging on levels that historically precede explosive upside. In his analysis, silver is poised not just to follow gold, but to outperform it decisively as the next phase of the bull market unfolds. Before we get into the deeper mechanics of Oliver's spread framework and why silver may be approaching its most important moment in over a decade, please take a moment to like this video, subscribe, and share it with others who follow the precious metals space. Your support helps us bring high-level analysis directly to investors who want clarity, not noise. We appreciate the support and hope you enjoy the video.
If you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100, cut in half. Okay, that was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up 8-fold from price low to bull high. Okay, these are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for, 2 decades almost. Okay. And then in 2001, with a low at around $260, it surged the second time. And when it peaked in 2011, a longer bull market, but the same dimension, 8-fold gain in price, bear low to bull high. Okay. And then it topped and you had to drop back to $1,050 in 2015. And if you measure that as the bear low that, followed that high, we're only a 4-fold move. Again, that low was 1,050. We're $4,000. Okay. You go to 8,000 plus, and then you could at least say, oh, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000. But anyway, the point being here, quit talking about gold being overdone. Okay. And then there's a more important chart, the one we're really, MSA looks at momentum and structure. But in this case, what we're looking at is simply price versus price, a spread chart. And back in 2013 in particular, gold was collapsing. Peaked in 2011, went sideways 2012, and really started to come apart in 13.
And this is gold. And this is gold divided by the S&P.
Yeah,
so
this is take a front month gold future, divide its price into the S&P, express it as a percent.
Right. So anytime the chart goes down, it's the S&P outperforming gold.
And gold underperforming the S&P in this case. We could have flipped it the other way as well, but in which case you'd have a topping pattern as opposed to a bottoming pattern by gold. But anyway, you can see that since 2015, when gold made its bear low in price, that was when it was just above 50% there. It was right where gold price actually ended the downside. If you go sideways from there for 10 years, you've been either side of that level equally. Meaning, it depends on when you look at it, but gold's been par to the S&P. It's done just as well as the S&P with ebbs and flows, better times, worse times, but sideways. Now, but in that period of 10, 11 years, I count 1, 2, 3, 4 highs that define a gradually declining resistance line. We hit it back in April. That's when gold was surging in net price. That's when we hit it the last time there. That's April of this year. No, the other time. There they go. That's when gold was surging in price when the S&P was dropping 20%. That's not supposed to happen according to common wisdom. When the S&P gets kicked bad, gold should go down too, right? It's falsehood. Anyway, you did back off from there, and gold went sideways in price for 5 months. It hit 3,500 and just went dead. Constant selling, but no real sustainable downside gains for the bears. Now you're intra-month with a week to go in the month, you're at 61%. You close a month at 60% or higher, dividing December gold future into S&P, and that's a breakout. So what this chart is telling you is if this were a price chart and the average guy looked at it and say, oh boy, this is a major breakout, I got to buy this thing. Well, that's right. It's telling you that gold is, while it's been doing okay versus the S&P for a decade, in real terms, up and down, but sideways, it's breaking out. This is just starting. This isn't some old game. It's just starting. That's a fresh breakout. Again, if this were a price chart and you saw that happening, you wouldn't say something's about to end. You'd say something's beginning. Okay. So what this is telling us is there's a major asset class shift out of especially the U.S. stock market bubble, which is probably the biggest one in the world. Many other markets don't have bubbles like we do. They're up like us, but not bubbles. And into monetary metals. We've already seen evidence of that. The last couple of years, gold's been doing well versus S&P, but it's only begun. We've just broken out of the massive base. So when this breaks out, it's likely to happen this month. All you do is hang around on the spread and it breaks out. This thing's going up for years. You don't have a base like this that go up for 2 months and then fail. This is the start of something. So it's an investment grade smack in the face. Reality's changing, guys. Something's going on. And it's also when you hit those levels before and you go about 6 months to the right, you're not fooling around. You're headed down. Okay. That resistance you didn't come back a second time and get back above the first peak. Each time you hit it, you didn't get back above the peak that hit it. You started down. And either that meant gold was going down in price or gold was going sideways. Like from that 2020 high, collapse in the spread was big. Gold also went down, went down 20% in price from over 2,000 to just above 1,600. But it also dropped a lot versus the S&P was firming then. Okay. In fact, S&P was making a high and NASDAQ 100 was making a price high in late 2021 when that spread was below 40%. That lowest reading you see there. That was a coincidence, but gold go down and stock market making a peak, price peak. Anyway, since then, you pulled up, built a base, a little mini base there, and you broke out of that back in March of this year, earlier this year, and then surged up to the April high. But this time, instead of falling down away from it and continuing down, you're back above it. It's a statement of intent. Okay. Anyway, this is a table pounder, and this is the kind of thing that if you're thinking of investing long term, it's saying you need to reorient your thought process. Something's going on here.
Silver's structure is distinctly different from gold's, and that difference is precisely why Oliver sees such powerful upside potential. While gold has already confirmed a major structural breakout relative to the S&P, silver has spent several years in a staircase decline relative to gold, even as it held its own in absolute pricing terms. This divergence has produced an exceptionally tight, compressed spread, the kind of compression that rarely resolves gradually. Historically, when silver reaches these low spread readings, it does not stabilize, it reasserts itself. The current readings, hovering just above levels seen during the 2020 surge, place silver back at the edge of a trend line that has defined the metal's underperformance cycle since 2021. A move through the horizontal ceiling at roughly 1.32% on the silver versus gold spread would represent a clean break of a 3-year structure.
And there's another spread we're watching also, if you want to flip a few pages beyond in that report that we were looking at. This is a very informative chart. It's effectively hit what it's saying is zero. Okay, I'm not going any lower. Okay, this is a spread chart here versus silver versus gold, the top chart.
Okay.
Top chart's a spread chart. And it's week to week instead of month to month. And we go back to 2020. And back then, that's when silver and gold both surged into late 2020. And gold went up 40%, but silver doubled. Okay, so this spread went, ooh, wow, an explosive move in a handful of 6, 7, 8 months, okay, in terms of percent gain in price and percent gain on the relative basis. But then in late 2020 and early 2021, the spread peaked at 1.5% thereabouts and dropped. Now, silver also, like the miners back then, while gold went into a range for a couple of years, sideways range, up and down. Silver and the miners went into a more or less staircase decline. And it particularly shows on the spread chart. So while gold was sort of going lateral, they were sort of going staircase down. So the spread deteriorated. Now, during that time, silver was going up in net price. I mean, you can go back to, 2022, there was a low there at 1.05%, but, the spread's above there now.
And just a quick note for the audience. Yeah. This is another ratio chart that we're looking at. So anytime the chart goes down, that's when silver's underperforming gold.
It could be going up in price at the same time.
Right.
It's still underperforming. Now, recently, you'll notice since March, April of this year, which is when gold stalled, remember, at 3,500, the spread has exploded from what are historically very low levels for that spread. Getting under 1% is like, it ain't going free, okay? Right. You're buying something that's next to free. So silver shot up, and it's now, this is last week's close, marginally above a downtrend going back to 2021. But the better line in our assessment is that green line, the horizontal. Mm-hmm. And that line gets taken out. We're dividing these silver into these gold and expressing it as a percent. That's how you come up with this number. 1.32%. You ever see a weekly close of December silver versus Dece gold that puts the spread at 1.32, blows out that ceiling that goes back to 2022, 3-year ceiling, perfectly horizontal, very clear. Okay, but already it's taken out a trend line. Now, if you'll scroll to the chart below, it's momentum of that spread. Okay. What we do is we take those spread readings you saw above and plot them in their relationship to a 40-week moving average of the spread. Okay? Mm-hmm. 40-week average is almost like a 200-day line or a 3-quarter average. So is the spread above that average or below it? And you oscillate it accordingly. And notice that it's created the same horizontal structure. Mm. The only difference is we're at it. Momentum almost always leads price. The level that's important there is about about 0.14. You can see the scale on the left. Okay, so if silver spread, it closes 0.14% above the 40-week average, which is the zero line. It will blow that ceiling. And we hit it about 2 months, 3 months ago, backed off, and right now we're pressing at it again. Now, you close a week out on the spread chart at the top, about 1.26%. It's going to cause this spread momentum chart to break out. Almost always when you have a momentum breakout, the spread will follow. Or if this were momentum of price, then price would follow. So we're focused also on the momentum of the spread, because when it breaks out, that gives us a heads up. Expect the spread chart itself. Now, what does this mean? It means as gold enters a massive asset shift favoring itself versus stock market, within the monetary metals, silver's about to shift into a leadership position. So yeah, gold thumbs up, but silver 2 thumbs up, because it's going to beat gold. So if you're focused on monetary metals or miners, my personal emphasis is on silver and silver related, as opposed to gold and gold related. So anyway,
so silver miners over gold miners.
Yes, they're lagged. For instance, right now, if you look at the SIL ETF, the silver miner ETF, it's not above its 2011 price high. SIL, 2011 high. You can see it over there to the left. We're not above it. It's a 90 something. We're trading in the 70s. Okay. GDX, if you hit it, which is the gold miner ETF, that's not it. Global X, that's silver miner still. Okay. GDX, there you go. It's above its 2011 high. So the gold miners are beating the silver miners right now. But what we're arguing is that when the spread breaks out favoring silver, you can bet that the silver miners are going to do a sudden catch up to what GDX has already done, namely blow the hell out of all highs in history. Okay. And SIL isn't even above the 2011 high. Don't be negative because of that. Yes, it's been lagging the miners. But if that silver spread breaks out versus gold, and we also run spreads of SIL versus GDX, it's on the edge of breaking out too. So I think there's a shift underway here.
And here's SIL versus GDX.
Yeah, if you take go back to 2022, you can see that, right there, there's 3 years worth of action you're seeing. Look at what's going on. It's a slightly declining relationship. It's really not collapsing. Yeah, that trend line is important, because if you draw it right, you're right. Yeah, there you go. It goes through 4 highs, high closes, monthly closes on the spread, the green candles you've got there. And we backed off from it. Okay, you close a month out at about 93.6%. GDX expressed as a percent of the price of SIL expresses as percent of the price of GDX. This spread breaks out of what we would determine to be a 3-year gradually declining base or channel. And I think you would explode up out of that spread relationship, meaning the miners will catch up to the gold miners, silver miners will catch up to the gold miners. And I think they'll do it sharply, because this little structure here is very potent, very compressed.
Across the full spectrum of indicators, Oliver believes the precious metals market is entering a multi-year realignment. Gold's emerging breakout against the S&P marks the market's first major recognition that monetary assets are undervalued relative to U.S. equities. The absence of any external crisis while this breakout develops is what makes it so important. Historically, gold has tended to outperform only during major shocks or periods of forced capital rotation. Today, it is outperforming while the S&P remains near historic highs. That suggests the capital shift is not driven by panic, but by early, strategic repositioning. Exactly the kind of flow that sustains long-duration bull markets. Gold's long-term picture remains exceptionally strong. Whether gold eventually reaches $8,000 or far beyond, Oliver's point is that the bull market is structurally early, not late. The recent consolidation above $4,000 is part of a normal rhythm, not a topping pattern. And when the gold versus S&P spread finally confirms its breakout on a monthly close, that signal will likely define the next several years of asset allocation shifts, away from stretched equities and toward monetary metals. If stocks continue struggling beneath the surface, and if geopolitical pressures remain unresolved, gold's role as a stabilizing anchor becomes even more central. Silver, however, is positioned to be the star of this cycle. Its spreads, momentum structures, and minor relationships all point to an asset preparing for leadership, not lagging. Oliver's work suggests that the market is on the cusp of a decisive turn in favor of silver and silver miners, a turn that could unfold sharply once the compression unwinds. For investors who understand structural setups rather than short-term noise, this is one of the most important signals in the precious metals market today. If you found this breakdown valuable, please like the video, subscribe, and share it with others who follow the gold and silver markets. Your support helps bring detailed, data-driven analysis to a wider audience. Thank you for watching, and stay tuned for the next deep dive into the forces shaping this unfolding metals cycle.